Hey there, everyone. Happy Friday, March 6th. Welcome to Chart This with Dave Keller. Great to be back with you live here. As we wrap the week, we're planning to rotate back to a live show every weekday after the close at 5 p.m. Eastern, 2 p.m. Pacific. So I appreciate you guys joining me, those of you that are doing so live. And if you're watching the replay at some point over the weekend, hey, welcome as well. Thanks for joining me. We're coming to you from a kind of classic overcast, kind of drizzly winter day here in Redmond, Washington. Hope you guys are all doing well wherever you're tuning in from. Not a great day for risk assets, as you may have noticed. A lot of red on the monitors with the S&P and the major averages finishing lower. The VIX almost finished the week above 30. The S&P breaking below our initial line in the sand of 6,800. Bitcoin rotating back to the downside. Crude oil accelerating to the upside. Plenty to talk about. We're going to do a quick market recap here on Friday, and then we're going to get to some of the awesome questions you guys have been sending in through the course of the week. As a reminder, you are always welcome to put questions on our YouTube channel. Any of the videos there on our channel, you can drop a question there in the comment section. We'll look at all of those, hand select some really good ones. I've got about 5 really good questions that have come from you guys in the last week. Keep them coming. We are doing this live, so if you're tuning in on the live stream, you are welcome to drop a question at any point. On whatever platform you're streaming this, I can see your questions in the live stream platform, so ask away. Now, with that in mind, here's what happened in the markets today, and as a reminder, right, I do a big weekly report over the weekend for my Market Misbehavior Premium members. This is an appetizer with a quick recap of what happened. I like to spend some time thinking a little bit more deeply about what I learned this week and some big takeaways, and I share those with my premium members. You are more than welcome to join as a premium member. Always have room for a couple more. You can find more info at marketmisbehavior.com/premium. Do me a favor and use the code YouTube when you check out for 30% off your first 12 months on any plan. It would be great to have you there. A lot of great content for members only. You can enjoy it as well. Here's what happened today, right? The S&P closed below 6,800. That was our initial line in the sand. I will try to grab that chart in a second. But the S&P down 1.33% to 6740. The NASDAQ composite even worse, down 1.6%. Mid caps and small caps underperforming even more, down 2.4%. Look at the VIX, which accelerated going into the close. Right, there's a bit of a bounce here in the afternoon, but the last hour, stocks rotated lower, volatility spikes, almost got above 30. We haven't been above 30 since the April 25 market low almost a year ago. So it's been quite some time since we've had a real extreme volatility event. I would say going into this weekend, we're seeing that. Anytime you see this sort of spike, an acceleration in volatility, a drop in risk assets going into the weekend, I immediately, and most investors kind of have Black Monday vibes, right? If some negative news would kind of come out over the weekend, you can open really weak on a Monday. That's always the danger. We'll see what happens. A lot of news flow rapidly coming out of the Middle East, which is causing, certainly a part of the narrative that we're observing playing out here today. But the VIX 5+ points higher today, which is, I would say, one of the key stories. Bonds were actually pretty noisy today. Bonds actually opened weaker and then traded higher into the close. The 10-year yield ended up not too far away. Same with the long bond yield, not too far away from where we closed on Thursday. 10-year yields around 413, we'll call it. The long bond yield around 475. The TLT, which is a bond ETF, actually rotated lower in the afternoon as stocks sold off in the last hour. Bonds did as well. The dollar was essentially relatively flat by the close. Huge move in commodities. Of course, crude oil remains top of mind with threats of stability or instability, as it were, in the Middle East. Pressure on crude oil prices. As a reminder, when we look at crude oil prices here in the U.S., we usually look at WTI, which is West Texas Intermediate. That's kind of the main U.S. benchmark. Brent crude oil is the European benchmark, and that's the one. I mean, they're both going up a lot, but Brent crude oil getting more upward pressure, obviously, because that's sort of the benchmark most closely tied to what's happening in the Middle East. It's so interesting, this conversation about what do we do about about a huge growing military conflict in the Middle East and what's the playbook look like. I had two great interviews on the podcast this week, one with legendary portfolio manager George Noble, the second with chief strategist Lindsay Bell of 248 Ventures. Just released that this morning. I asked both of them, what's your kind of geopolitical disaster playbook? What does it look like? Both of them gave me some version of take a deep breath, take a big step back, think, filter out the noise, focus on the longer trends. Lindsay did a great job talking about earnings and how we're looking to see how it impacts companies' earnings and changes in guidance and expectation. So I'd encourage you to check out those interviews with George Noble and Lindsay Bell, two really good interviews with some smart market practitioners. Gold and silver, by the way, moving higher as well, but not as much. Cryptocurrencies all in the red. You can see Bitcoin now back below 70K, currently trading right around 68,300. That is, as we wrap the week here for equities. Not great in terms of breadth. Looking at the sectors, technology leading the way lower, down 2.1%. Only two of the S&P sectors finished in the green, and the number one was consumer staples, one of the more defensive sectors. Energy, number two, not up a ton, even though crude oil prices are accelerating. It's really more about the uncertainty, the instability, the fear. So we're seeing bond proxies and energy do well. And when I'm saying bond proxies, if that's a phrase that doesn't make sense, higher yielding stocks that have kind of lower volatility are kind of as close to a bond as you can get while still buying an individual stock. We call those bond proxies, things like utilities, consumer staples. These are things that tend to have lower volatility, bigger income component, almost like a coupon payment. So there we go. Breadth was bad today with a capital BAD. 84% of the small cap index was down today. 77% of the New York Stock Exchange. Those are bear market numbers, to be honest with you. And it looks pretty likely that our market trend model confirmed short-term bearish on all the major U.S. indexes. All the Magnificent Seven and friends going down here. So here's the chart of the S&P 500 breaking below that 6,800 level. That's the level. I don't have the traffic light on this particular chart, but that's the level of support we've been talking about. Look at all of these bounces in January and February off that 6,800 level. And this was Tuesday of this week, and the bounce higher Wednesday, Thursday. Here's today. So talk about finishing the week not in a great place. That's what happened today, right? And that's very different than last week, where it looked like a really ugly week, and then Friday was like this awesome update. It's like, okay, I guess things aren't that bad. I feel like things are that bad. Again, I'm going to dig into a lot of these in a lot more detail, but in terms of breadth, less than 50% of the S&P 500 members now remain above their 50-day moving average. That is a kind of crucial breakdown in breadth that we've been suggesting would be a warning sign to look for. It looks like that warning sign indeed fired. So in answer to someone's first question here, the S&P closed under 6,800. Is it time to go to sidelines for a better buy? I mean, definitely, for me, breaking below 6,800 is a meaningful short-term level of support. The whole point of a line in the sand is as long as we remain above that, things are okay. When we break below that, things are no longer okay. I think things are no longer okay. Now, are they really bad? Is the chart of the S&P bad? Like, no, I would say it's gone from good. It went from great to good in the fourth quarter. It's now gone from good to okay. This is the proprietary Dave Keller four level rating system for the market. And I think the S&P below 6,550 would be bad. I think that's a bad chart. That's an ugly chart. That is a larger rotation. The weekly chart of the S&P still looks pretty good. Our market trend model still bullish on the medium-term time frame, it looks like. So, it's okay. But okay is not a great chart to own. I'd much rather own good and if not great charts as I'm looking around and where to put my own assets. All right. I'm going to continue on here doing some mailbag stuff. Here are questions that I've received from all of you guys. And now that we're doing the show live, two ways to get questions to us. As always, anytime we're live streaming, put a question in the comment section. I can review, or in the comment section on any of the live stream platforms, because we're on Facebook, LinkedIn, YouTube, and X at the moment. On our YouTube channel, the comment section there, always welcome to use that. And that's where we've gotten some of these great questions. Question number one, regarding ROST stores, ROST, that's one of those consumer discretionary names we've been highlighting anytime we can because it's just a good long-term chart. Your question, since the end of November, RSI has shown lower highs, even though all are over 70, while the stock is going higher. Indication of divergences and a loss of momentum. So let's look at the ROST stores. It's interesting that the within consumer discretionary, there are plenty of charts that have not looked as strong, but some of the apparel names have looked remarkably good. And ROST store is probably one of the better examples of just a chart in a primary uptrend phase. Just long-term uptrend, right? Higher highs, higher lows. And what's so funny is, like, back in August, September of last year, it feels like every chart in the US was kind of like this, or almost all of them, right? They were all kind of in these nice uptrends. Now charts like this, with the price making new highs this week, with the moving averages in the proper order, all fanned out, with the momentum strong, with the relative strength, like, you're just not seeing as many charts like that. And I think that's a good reminder of, wow, like these kind of charts are usually a good idea in any environment, but especially now when the benchmarks are flat, slightly breaking down, when a lot of charts do not look anything like this, even more important to have a process of identifying these stronger trends that remain in place. Your question is particular to the RSI, and you're basically saying, look, since November of last year, right back here, every time we're making a new high, it seems like the RSI is a little bit lower, right? So here it's around 76. Here it's around 75. Here just right at 75, maybe a little below. Here we're down around 72, 73. And your question is that a divergence? So the short answer is no. I wouldn't think of that as a divergence. This for me is kind of the classic divergence where the price is going higher, the momentum is trending lower. We're overbought on the first peak. We are not overbought on the second peak. What you have to remember is, in a healthy uptrend, we should be coming overbought every time we make a new high. Like, that's kind of the best situation. And this is why I cringe when someone says, well, overbought is bad, we should be selling. I'm like, no, like, this is not the time I would be selling ROST stores. This is a signal that, hey, this stock is in a strong uptrend phase and we're still making higher highs and higher lows. That's the kind of uptrend I want to follow as long as possible. So the idea is, when we keep making new highs, do we get to that overbought region? And if we're just slightly less overbought but still overbought, I don't really think of that as a divergence. For me, the big divergence is when you make a new high and you don't get to that overbought region, because that tells you that the momentum you'd normally expect in a healthy bull market trend is not present. And while that doesn't guarantee a major top, while that doesn't guarantee a certain percentage retracement or anything like that, or even a timing implication, it's just a lot of major tops have had those divergences. And I've seen enough of them to know not to ignore them. Divergences, though, there's a famous quote on divergences by Justin Mamis. Justin was a technical analyst. He wrote some fantastic books back in the day, and one of my analysts at Fidelity, Mark Dibble, actually worked for Justin Mamis earlier in his career, which was a lot of fun. He shared some great stories about him. But his quote on divergences are like laxatives. You never know if one is enough or two is too many. Like, what a great like old man quote about divergences and relating them to laxatives. Brilliant. And so the point, I mean, what does that actually mean in terms of the chart? Right, divergences can happen. You'll have multiple divergences a lot of times during a big uptrend, particularly something that's been an uptrend for quite some time. So I've learned not to overreact to divergences. For me, divergences are like a warning bell. The breakdown, the break below support, the break below a line in the sand, that's what validates that those divergences you saw are really a problem. Hope that helps. So at this point, am I concerned about ROST stores? I'm not at this point. The fact that it's making new highs on overbought conditions, I would argue still good at this point. Next question. When comparing sectors to a benchmark or index, is it better to use cap weighted or equal weighted? And you have some of the, you have ratios, right? XLK to SPY, those are two cap weighted ETFs. RSPT and RSP are the two equal weighted versions of technology and technology, and then the S&P. So, I mean, the answer to your question is, it depends. It depends. Is it better? It depends on what you're trying to do. If I'm thinking about, I might be, I'm thinking of an allocation to technology. What's the relative performance? Well, if you're buying the technology sector, if you're buying the XLK, then that's what I would be using, right? And so cap weighted indexes and cap weighted ETFs are often very concentrated at the top. They're very top heavy, right? So the XLK, it's like Apple, Microsoft, Nvidia are a huge part of that ETF. Same with consumer discretionary with Amazon, Tesla, Home Depot. Same thing with energy with Exxon and Chevron. Communication services with Meta and Alphabet. So a lot of the 11 S&P sector ETFs have that kind of top heavy issue because the biggest companies are just so big. But having said that, right, if you're going to own the XLK, like that's what I think you need to be analyzing is the relative performance, because that the cap weighted structure is the return profile that you're tracking. If I want to think about, do I want to be investing in technology stocks versus the market, then I would say it might make more sense to look at the equal weighted version of that. So here I'm doing the equal weighted technology versus the equal weighted benchmark. The answer, what this ratio is telling you, which is what you asked about, that's basically saying it's more like, is the average stock in technology doing better than the average stock in the S&P? And it's not exactly what it's saying, but kind of that's how I would think about it, right? So it depends on whether you're thinking at the sector rotation, sector allocation level, or where do I maybe find some opportunities at the stock and group level? And depending on which question you're asking, I think that would inform. In reality, what would be awesome, you look at both. I actually have a series of charts. Ooh, I haven't looked at this in too long, and I don't even remember what it is. Here we go. Equal weighted versus cap weighted ETFs. And what I've done with this chart list here on stock charts is basically each one of these takes a sector. So here's communication services, the equal weighted versus the cap weighted version. So here I'm actually looking at how the equal weighted version of the ETF is doing versus the cap weighted version, which tells me, is it the larger or smaller names within each of those 11 S&P sectors? I think looking at this series of charts, along with the two series that you implied, the cap weighted and equal weighted, you go through all of those charts, you're going to understand pretty well about where the leadership is, if it's the leading names or the smaller names, and you have a pretty good sense of where you might find opportunity. So ideally, you spend time looking at all of those. In the quick version, it depends on what your question is. I hope that makes sense. Next question, how do you feel about the election cycle and where we fall in the typical progression, with the market trending sideways since October and moving into a typically bearish period? So here's the thing. You use the word typical and typically a couple times in your question. I think that's what you have to remember with seasonal. I call them seasonal tendencies, right? You're right in that this tells you what typically happens. This is what generally happens, barring some, one-off events. And I've gone to the source. I've talked with Jeff Hirsch, whose father, Yale Hirsch, is credited with kind of popularizing seasonal investing. He edits the Stock Traders Almanac to this day. Jeff does, started by his father, Yale Hirsch. And I've interviewed Jeff a number of times for my podcasts and have gotten to know him. And really, I mean, he's the guy. He's the authority on seasonality. And he would tell you, look, that the seasonal playbook, right, what you see in the Stock Traders Almanac is basically an idea of here's what should happen, barring other stuff that's going to go on. And I'm not just saying this, like I literally have the Stock Traders Almanac over here next to my one monitor. I always have it open. I always just kind of check it just to think about, all right, barring any other big things happening, here's like the most likely outcome. But we are living in a time where I feel like every day has one-off stuff that's happening. It's like we're not really leaving the market to its own devices to just see what happens in a normal election, midterm election year. This feels like anything but. And the military action, the instability in global geopolitical things, just the whole the presidential administration in the U.S. and just the social media legislation that's happening. I mean, it's a crazy time where the volatility of news is pretty high. So is it helpful to kind of look at these? So what I'm doing is basically looking at the seasonal charts on stock charts, and I'm only looking at the midterm election years, right? So 2026, 22, 2018, 24. So I'm graying out the rest of them. So I'm just looking at midterm election years here. I mean, has the market so far followed the traditional pattern? I mean, no, not really. It hasn't really followed the seasonal pattern just yet. If we are following the traditional midterm election pattern going back to 2006, March should be a pretty decent month, actually. It's up 80% of the time, average return 1.9%. April is an average down month, but still generally up more than it's down if you look at the batting average. So we're going into a period, but usually in a midterm election year, April, May is where you tend to have pretty weak action, and then June, right? Look at the average returns in midterm election years for the last 5 observations. Second quarter has been the weakest. So usually first quarter a little stronger going into like a March, April peak, and then April, May, June are a little weaker. So all of that is a long-winded way of saying, if I'm bearish, it's probably at this point less about the seasonality, to be honest with you. It's more about just the conditions that I'm seeing in the breakdowns of support and the weaker breadth conditions and stuff that we've been highlighting it. I mean, the fact that the second quarter is usually pretty rough in a midterm election year, not helping things. I don't think that's going to help us, but overall for me, it's less about this, just because all of the one-offs, particularly events in the Middle East. This is one of those things that would completely derail the normal seasonal tendencies, in my opinion. All right, we'll be back with a couple more questions here in a moment, but just wanted to let you guys know, shout out to one of our partners, Seeking Alpha. They have a platform or a product called Alpha Picks. If you go to marketmisbehavior.com/alpha picks, you can get more information. If you use my link, you'll get 10% off an annual subscription to their Alpha Picks. They hand select 2 stocks a month using their proprietary quant model. I'm a fan of their quant model. I think it's, high quality. It reminds me of models I've used at the institutional level, but it's accessible to individual investors. They dive a little deeper into 2 stocks a month. The returns in that portfolio over time have been very, very good. As always, past performance is no guarantee of future results, but maybe worth checking out to give you some ideas. You can find more info at marketmisbehavior.com/alpha picks. And thanks again to the good folks at Seeking Alpha for being partners to the channel here. All right, next question. Dave, I noticed that you are plotting 21-day exponential moving averages and plotting 50 and 200-day arithmetic moving averages. Yep. Why not use exponential moving average for all 3 plots to maintain the similar filter response for each? That phrase, filter response, is one I don't really understand, but I'm going to assume it has some sort of engineering connotation or mathematical connotation in terms of how it's treating the data, is how I would interpret that. And that makes sense. Yeah, there's a big difference, right, between a simple moving average and an exponential moving average, right? And so for me, why use this particular combination? I'll be honest with you, I used the 50 and 200-day simple moving averages for the longest time. And the main reason why I did that was when I started teaching people technical analysis after I was at Bloomberg for a couple of years, really started to learn the toolkit, started learning from some really great mentors, started going out around North America and teaching institutional investors how to use technical analysis and answering questions about it. I found that even investors that were not big chart people always would bring up a chart, and the default would always have the 50 and 200-day moving averages on it, and they would often know where that was. Buy-side trading desks around the U.S., even if they were not big chart people, they always knew, the traders always knew where the 200-day moving average was, because they believed that other people would be using that and trading around it. So for me, the value of looking at the 50 and 200-day simple moving averages, the value is I know a lot of other investors, many of which run portfolios with lots of zeros in the accounts, are looking at those averages. And so I think that's why something like the 200-day moving average is often a really good barometer of a trend, because many other people are using that to just measure the strength of the trend. I actually added the 21-day EMA later, and I did that as I went on, and I'm managing my own portfolios, and I found the 50-day moving average just wasn't a great trailing stop for me in certain situations. And I found I often, by the time the price would hit the 50-day moving average, particularly stocks in a big uptrend, I feel like it would already have broken down to a degree that I felt like I'd missed out on that initial pullback. So I started using the 21-day EMA. I started using another indicator called the chandelier exit system after reading Dr. Alexander Elder's books. And those two things are more short-term kind of trailing stops. I started using those as initial stops on the way up. And that helped me to, just be a little better at recognizing tops and being more thoughtful and intentional about when I was starting to unwind positions. So that's the reason. 21-day EMA, I think, is a great trailing stop as an initial, signal that a price may be turning. The 50 and 200-day, I think, are so meaningful because so many investors use them. It's arguably not a particularly great way of averaging price action over time, but it's widely followed, and I think there's value in that. Next question, Dave, you occasionally use Fibonacci number averages, 5, 8, 13, 21, and 34-day EMAs. You're absolutely right. Would you please explain further how you would use the whole set of EMAs? That's an awesome question. Boy, do I have a chart like that. I hope I do. I used to. Here it is. Here's one. Moving average ribbon. Listen, this isn't exactly what you're asking about, but it'll give you an idea. And you're inspiring me now with your question to think about it a little more. So 2 answers to your question. Number one, why do so the Fibonacci numbers, that's one of those classic things. And I remember taking this away from an early conversation with Tom DeMark. His first indicator that really, was widely followed is called TD sequential. It looks for a 9-bar setup and a 13-bar countdown. And he was asked, the first seminar he gave that I was in the audience, he was asked, why'd you pick 9 and 13? And he said he started with 8 and 13 because they're Fibonacci numbers. And I was like, that is a great way to do it. And then he started there and then started tweaking it and found that a 9-day setup period just tested better. So he started using that. And then he started tweaking things and everything. But it was a great reminder, like, good way of thinking about it. All right, Fibonacci numbers, I start there and then I tweak it from there. That's why my market trend model, I think to your point, uses the 5, 13, 21, and 34-week exponential moving averages. I use Fibonacci numbers, and it's a good set of periods to, for most things you're trying to do. I find that some combination of those is usually a pretty good fit. Now, so that's why I kind of start with those. Your question was, what if you use all of them? There is a technique, which I call like a moving average ribbon. This isn't exactly what we're talking about because this is using simple moving averages and not exponential moving averages, but you could easily use either. It's going to look probably a little better with exponential averages, but just, humor me with this. The idea with the moving average ribbon is you look at the whole shape of it. And one of the ways that I've seen it is like the shortest term one and the longest term one. You can even have one color, and then you can have the middle ones all like a gray, like a more neutral color. I've seen people that go like light to dark, anything that's going to help you sort of recognize the shape. And then instead of actually just looking at individual moving averages, you're looking at the entire shape of the moving average, right? So here, I'm looking at an uptrend with the moving averages all trending higher, the short-term ones above the long-term ones. So here I have the 10, 20, 30, 40, 50. Here's the 100, 150, and 200-day moving averages. I can easily see a downtrend where the moving averages are sloping downwards and the longer-term ones are here. I can see a transition when they're sideways. So I can see when a chart like Apple is kind of chopping around. If you'll note, I actually have the price itself removed from the chart. I'm just looking at the shape of the moving averages. And this was an exercise I used to do with a portfolio manager that I work with. We'd go through all of his holdings just using the moving average ribbon and just let's make sure that we own more of this kind of thing and less of this kind of thing. So that's kind of it. And I'm glossing over a lot of the nuances of it, but a number of people like Dave Landry has what's called a bow tie pattern where you kind of have like the moving average, 3 moving averages, and they flip. And so they kind of rotate, and that's a signal. There are a number of kind of techniques that use multiple moving averages and look at the shape of them all together. But I love that ribbon technique. It's really good at recognizing if you have a bunch of stocks, you flip through them, you'll immediately see the ones that are in that kind of positive trend. It just immediately it clicks for you. So that's one thing that you can do, looking at a whole set of moving averages and trying to try to relate them. All right, I'm going to take one more question from the live stream here before we finish off. Appreciate all these questions. Yeah, right angle. I love your handle's awesome. At right angle triangle. That's killer. For 20% of the world energy supply being held up, the market hasn't priced the full impact. So 100% agree with you, and I think that's one of those interesting realities about about what's happening in the market. I mean, and again, I think there's so many nuances to this. We love to think very simply, like, all right, the U.S. and Israel attacked Iran. What's the playbook? What's the outcome? This is I mean, we're in, pun intended, uncharted territory in so many ways. The fact that, I mean, there's a reason why that region is so vital for oil production and oil distribution. Particularly, I was watching a video yesterday that, a huge percentage of oil for Japan, China, India all goes through the Strait of Hormuz every day to supply those. So if there's a huge disruption, that could be incredibly impactful to the global economy. And if you think the U.S. is energy independent, that's true. Are we producing more oil than we're using? That's true, which was not true 30, 40 years ago. That's true now. But would a huge disruption in the Middle East still weigh on the U.S. economy? Absolutely. Because you think about how much of the companies in the S&P 500 are reliant on operations outside the U.S. Those non-U.S. consumers and employees are needing oil and all of those other things as well. So the potential for disruption is huge. The question that is really hard to figure out at this point is what is going to be the scope and scale of this conflict? How many actors are drawn in? Does it get significantly bigger? Are there boots on the ground? Who all, and again, there's just so many open questions and again, every day I feel like we're getting new headlines. So I'm not a CIA operative that I can tell you with great authority about what's happening with all of the geopolitical things. I am a chart specialist and I know those pretty well. And I'm telling you, the charts are showing minimal reaction right now. The real pain you will see on the charts is when consumer sentiment starts to get affected, when non-U.S. companies, operations outside the U.S. start to be disrupted, when you see it, when you hear it in earnings calls, that's when the market can really start to show some pain. Final question, Brian Silva, thanks for watching. Do you ever look at DeMark indicators? I've laughed with Tom DeMark about this many times. Early in my career, one of my favorite moments and also least favorite moments was a little stretch of time where I would travel around the U.S. doing seminars with Tom DeMark to promote his indicators on the Bloomberg terminal. I got to know Tom very well during that period, spoke to him often, spent time on the road with him. He is incredibly difficult to rein in on a stage. I will tell you, that tested all my mettle as a professional moderator and speaker and patient human being. It was tough, but I enjoyed it a great deal. And he introduced me to a number of great people. And I think of Tom as a mentor. Tom DeMark has created hundreds of indicators. I mean, tons of them. There are a couple of them that are very widely followed. I used to look at TD sequential and TD combo all the time. I used to work with traders, hedge funds in the Northeast of the U.S., looking at those on short-term timeframes, 1 minute, 5 minute timeframes, all the way to longer things. Some of my first trades were using TD sequential in my own account. Clean Harbors, if you remember, used to be CLHB. I remember buying a 13 and it worked, and I'll never forget that as a great trade using TD sequential. Do I look at them now? Not as much. I don't look at them all the time, but what happens is, what I found is, after you use those indicators for a long time, you almost don't even need the indicator. I'll see something happen on the chart. I'm like, that looks like it's probably like a 12 or 13. I'll print out the chart and do it by hand. And that process has been really helpful. I don't look at them often, but when I see a configuration on the chart that I'm like, I think, oh, that could be nearing one of those major exhaustion signals, pretty good. What's great about Tom's indicators, particularly sequential and combo, they're exhaustion indicators, right? So they're meant to tell you when the trend is exhausted. So it's often a pretty good leading indicator of a potential trend reversal. So yeah, I used to, at points in my career, not as much, but still will often find them helpful. And I'm glad, talking to people like Mark Newton and Katie Stockton and others that still use them daily. Always enjoy getting their perspective on those kind of things. Folks, thanks so much. Great to be back live. Thanks so much for some great questions in the live stream. Thank you so much to those of you that submitted a question. We had 5 questions that came from our YouTube channel this week. Please keep them coming at any time on our YouTube channel. Use the comment section to drop some questions. In the meantime, have an awesome weekend. I wish you a safe, wonderful, restful, joyful weekend. We'll be back on Monday. In the meantime, have a great one. And remember, it's always a good time to own good charts. Take care, folks.